Now, on this subject, Jeffrey Lacker was the president of the Federal Reserve Bank of Richmond between 2004 and 2017, where he had 4 rotations serving on the Federal Open Market Committee, deciding about interest rates in America. That was in 2015, 2012, 2009 and 2006. Also, he cast 8 dissenting votes during the Federal Open Markets Committee meetings in 2012. Now, Jeffrey Lacker is currently a senior affiliated scholar at the George Mason University and a member of the Shadow Open Market Committee. And Ed Boyd caught up with him this week and just started by asking him why it's important for the US Federal Reserve to be independent of government.
It's exceptionally important. I think history's proven that case. The times in which the Fed's gone off the rails in the last century or two has been times in which the administration, the White House, has leaned on the Fed heavily in order to keep interest rates low for various purposes. It's happened during Lyndon Baines Johnson in the late 60s, and then egregiously under Richard Nixon in the early 1970s. Presidents since then have tended to realize that it's in their best interest to keep inflation low, and for that, it's in their best interest to keep their hands off of the Fed and avoid the market's perception that the Fed's going to compromise its commitment to price stability for the sake of an administration.
Do you think the independence of central banks, is it being taken for granted?
So that independence has reaped significant benefits, particularly this 25-year period from the mid-1990s until 2020 in the United States, at least, in which inflation was very low and stable, around 2%, average 2%, very, very consistently. There was, with COVID, things got a little scrambled, and across the globe, there was a tendency of central banks to let inflation roll in order to support the fiscal stimulus that were put in place after COVID in order to help bolster the economy. Since then, I think that the fact that they had this 25-year period helped them recover more rapidly than they otherwise would. But that's shaken that credibility. So that credibility is a tad weaker, perhaps more noticeably weaker than it was before. And it's important not to shake it again because it could break loose.
President Trump's criticised Jerome Powell quite a bit over the last year or so. The latest thing's the expensive renovation at the Federal Reserve building. Could Trump possibly use this as a pretext to fire Jerome Powell?
It's not clear legally whether it would hold up as a grounds for cause removal. The standards are not quite clear on whether you could do this or not. I think it's clearly a pretext. The renovations wouldn't have been an issue without the interest of the White House in pressuring the Fed to keep interest rates low. So it's a renovation that, I don't know, looks in line with typical corporate headquarters. So I just don't see it being anything but an excuse in this case.
There's a few contenders for the role: Hassett, Warsh, Waller and Bessent. What qualities does someone need to be chairman of the US Federal Reserve?
Typically, it's required credibility on 3 fronts. One is on the Hill, Capitol Hill, with Congress, particularly in the Senate. Powell had that in spades. Credibility with Wall Street, with financial markets, and that means their trust that they can understand what you're doing, what you're going to be about, that they can predict in a general sort of way how you're going to react to incoming data, and that you're going to keep inflation low and stable. And then the third thing is with academia. This is maybe less important than it used to be, but to the community of monetary economists, both in academia and on Wall Street that follow the Fed, some sense that you know what you're talking about, that you understand current scientific evidence on the conduct of monetary policy and how that should lead the Fed.
Does it make sense for Trump to announce his pick soon to create a shadow Fed chair position?
So it risks confusion and disruption, I think, in financial markets. It risks a situation in which somebody outside the Fed, but who's going to take up the mantle some 8 months down the road, is asked to opine about events, and markets maybe aren't clear on whether to react to that person's opinions or the current Fed chair's opinion. So it's a bit disruptive, and probably not good for healthy conduct of monetary policy.
Once Trump's pick starts next year, Powell could stay on the board. And the board's made up of 12 individuals, so that could make it pretty difficult for the new Fed chair to start aggressively cutting rates.
It could, but more broadly, Powell will be one of 19 participants in the FOMC meeting, and even if Powell left at the end of his term as chair, the new incoming chair has the task of persuading a large group, 12 voting members, but as I said, 19 participants in every meeting, to go along with their preferred course of action. That's a difficult thing. It's a delicate thing. There's usually a measure of deference to the chair, but for sure the Fed chair can't take the committee too far from the center of gravity of the working consensus on the group.
Yeah, and what's it like attending those meetings? Can there often be fiery or robust discussion?
There was back in the day, for sure, in the great financial crisis, and in for several years afterwards. Nowadays, the meeting tends to be about positioning arguments for the next meeting. So when you come into the meeting, it's pretty clear what you're going to do. They've worked that out in phone calls the week before. So the meeting is basically to ratify the decision they've all made on the phone basically the week before. But the arguments made in the committee meeting are really to position for the next meeting and the meeting after that and so on, and try and persuade their colleagues to go along.
President Trump wants interest rates cut by 3 whole percentage points. What would America's economy look like if that was to actually happen?
That would be preposterous. It's a preposterous idea. I think it would be tumultuous. I think that financial markets would react with very volatile conditions. I think bond yields would go up significantly. I think there may be some financial stimulus, but the Fed would be forced to raise rates to counteract the inflation that emerged in the 6 months following that. So, yeah, I think it would be tumult.
And when you look at the Fed's recent meetings and minutes, do you agree with their actions over the past year or so, reducing rates by 1% and now waiting to see more information and data?
So I disagreed with their rate cut last September, and I think it was a little too aggressive, a little too soon. I think what we saw after that is that inflation has plateaued at above the 2% rate they were targeting. Inflation had been coming down, and their rate cut, I think, induced inflation to kind of stall out at closer to 3%, around 2.75% to 3%, rather than keep declining to 2% as they intended. So I think rates ought to be higher now than they are. So yeah, I think they ought to stand pat going forward for the rest of this year.
And what's the biggest economic challenge you think the president's facing? Is it the really high level of debt for the United States?
I think that's going to be a challenge. There's also, I think the labor force growth is going to be a real question. The lack of inflow of immigrants, which has been boosting labor force growth and boosting economic growth over the last couple of years. I think that's going to be a challenge. But yeah, I think over the next couple of years, interest rates are going to rise as this huge deficits roll into markets, and the Treasury has to raise a lot of funds.
Jeff Lacker, thanks so much for your time.
My pleasure. Take care.